Deposit. You hand over your paycheck and think you just stored your money somewhere safe, like dropping your suitcase at a hotel. Here's the uncomfortable part. The moment that cash hits your account, it's not really yours anymore. Not the way you think. Legally, yeah, you can pull it out. But physically, it's already gone, already moving, already out the door doing work for someone else. A deposit isn't storage, it's a loan. You just handed the bank your money, and in exchange, they wrote you an IOU, a number on a screen that says, "We owe you this whenever you ask." You're not a saver, you're a creditor, and they're paying you almost nothing for the privilege. Most big U.S. banks, Chase, Wells Fargo, Bank of America, pay between 0.01% and 0.05% on a standard savings account. On 10 grand, that's about $1 a year. Here's what actually helps. High-yield savings accounts from online banks, Ally, Marcus, Wealthfront, SoFi, Capital One 360, are paying around 4 to 5% right now. Same FDIC insurance up to $250,000 per person per bank, same liquidity, 40 to 50 times the return. If your savings is sitting in a traditional big bank account, you're actively choosing to lose money. One switch puts hundreds of dollars back in your pocket every year, passively. Also, never park more than $250,000 with one bank under one owner. Anything above that isn't insured if they collapse. Split it across institutions or use a joint account which doubles coverage to $500,000. That boring Tuesday deposit is the first domino in a machine that prints profit off your back. To understand how deep it goes, you've got to see where your money actually runs the second it leaves your hands. Money flow. Ever wonder what happens in that pause between deposit successful and the number showing up in your balance? Feels instant, clean, like your money teleported. It didn't. It took off on a journey. The second your deposit lands, the bank sorts it into buckets. A small slice stays liquid for withdrawals. The rest gets deployed. Some goes into mortgages, auto loans, business credit lines. Some into government bonds. The bank literally loans your money to the government and collects 4 to 5% on short-term treasuries right now. Some gets parked with the central bank earning interest. Some gets pushed into securities and interbank lending. Your money is on a world tour while you're home wondering if you can afford takeout. Here's the useful part. You can buy those same treasury bonds yourself through treasurydirect.gov. No middleman, no bank skimming the yield. T-bills, I-bonds, notes, all available to regular people, backed by the full faith and credit of the government. If you've got cash you won't need for a few months to a year, a short-term T-bill often pays more than a savings account with basically zero risk. Same idea in the UK with gilts and premium bonds. The bank is doing exactly what you could be doing. They're just keeping most of the return. That gap between money in account and money actually sitting still is the whole magic trick. It's everywhere but there. And that's how the next layer works. Fractional reserve. Imagine you run a restaurant and notice only 10% of your reservations actually show up hungry at once, so you sell way more reservations than you have tables. Sketchy? Welcome to banking. This is fractional reserve banking. Banks are legally allowed to keep only a small fraction of deposits on hand. Here's something most people don't know. In March 2020, the Federal Reserve dropped the reserve requirement to 0%. Yep, zero. Technically, U.S. banks don't have to hold any portion of your deposits in reserve anymore. They operate under liquidity rules now, but the old 10% thing from your econ textbook is outdated. The assumption powering the whole thing is simple. Most people don't pull their money out at the same time. Here's what to actually do with this. Never keep all your money in one bank. Spread it across at least 2, ideally 3. If one has a liquidity issue, your paycheck still clears and your life doesn't freeze, keep a few $100 in physical cash somewhere safe at home. When Silicon Valley Bank collapsed in 2023, ATMs ran dry and debit cards stopped working for days. And if you ever hear a real rumor that your bank is in trouble, move first, ask questions later. Bank runs happen fast. Early movers always come out okay. Late ones stand in line. Because when they're wrong, when everyone shows up at once, the bank doesn't have the money. It never did. Trust in the system is the money. Pull that trust and the whole thing folds. And yet this setup is the engine that powers what comes next. Loans. Somebody right now is walking into a bank asking for 50 grand to start a taco truck. The money they're about to get, it's kind of yours. You deposited a paycheck last Thursday and part of it's about to become a stranger's second chance, and you'll never know it. Loans are the bread and butter. This is how banks actually earn their keep. They take your deposit, paying you 0.05% and lend it out at 7, 9, or 22%. Mortgage, auto, personal credit card, all your money marked up. If you're ever on the borrowing side, here's stuff that saves real money. Check your credit score before you apply for anything, free at Credit Karma, Credit Sesame, or through your card issuer. Going from a 680 to a 740 can drop your mortgage rate by 0.5%, which on a 30-year loan is tens of thousands saved. Shop your rate. Don't walk into one bank and sign. Get quotes from at least 3 lenders. Credit unions almost always beat big banks by 1 to 2 percentage points. Online lenders like SoFi, Rocket, Lightstream often beat both. Mortgage rate shopping within a 14-day window counts as one credit inquiry, not multiple, so comparing won't hurt your score. Read loan terms for prepayment penalties. Some loans punish you for paying them off early. If you get a bonus, tax refund, or inheritance, being able to knock down principal early can shave years off the loan, but only if they don't penalize you. Avoid private student loans whenever possible. Federal ones come with income-based repayment, forgiveness programs, and way better protections when life goes sideways. You signed a stack of paperwork when you opened your account, and somewhere in there you agreed to all of it. That gap between what they earn and what they give you deserves its own breakdown. Interest spread. Picture 2 faucets. One's dripping, that's what the bank pays you. Maybe a few cents on every dollar per year. The other's gushing. That's what the bank charges someone else to borrow the same dollar. 7%, 9%, 22% on a credit card. Same dollar, same day. 2 completely different prices. That gap is the net interest margin. It's the beating heart of the banking industry. For most big U.S. banks, it runs around 2.5 to 3.5%. Sounds small, until you multiply it by trillions. J.P. Morgan Chase made over $90 billion in net interest income in a single recent year, just from the spread. Here's how you flip this in your own life. Credit card debt is the worst side of this spread for you. The average U.S. credit card APR is now over 20%. Every dollar you carry is bleeding money at mob-level rates. Killing credit card debt is often the single best investment you can make, a guaranteed 20% plus return just by paying it off. A 0% balance transfer card can buy you 15 to 21 months of no interest to pay down existing debt, typically for a 3 to 5% transfer fee, way cheaper than paying 22% for a year. Credit unions often offer cards at 10 to 13%, nearly half of what big banks charge. And here's the cleanest move. If you pay your card in full every month, you pay 0 interest and collect all the rewards, cashback, travel points, the works. That means you're using the bank's spread against them. Every swipe earns you something, and you pay none of their markup. That's the only way credit cards become your friend instead of your cage. The spread isn't the only place they're feasting. Wait till you see how it stacks. Bank profits. If someone asked, where does a bank actually make money? Most people would shrug and say, loans, I guess. That's one floor of a 10-story building. Beyond the interest spread, there's trading, desks moving currencies, stocks, bonds, derivatives, profiting on volume and spread. Investment banking, fees of 3 to 7% on IPOs and mergers. A $1 billion IPO means 30 to 70 million in fees for a few months of work. Wealth management, about 1% annually to manage rich clients' assets. On a 10 million portfolio, that's $100,000 a year, forever. Credit cards, both interest from you and swipe fees from merchants every time you tap. Every latte, every grocery run, every gas fill-up, the bank takes a cut, usually 1.5 to 3.5% of the transaction. Here's how you fight back. You are the product, and banks compete for your deposit, your loan, your card. You have more leverage than you think. Call your credit card company and ask for a lower APR. It works about 70% of the time if you've paid on time. Ask them to waive the annual fee. Ask for a retention bonus when you threaten to close. Mortgage rates, wealth management fees, all have wiggle room. Don't accept rack rate. Diversify who profits from you. If one bank has your checking, savings, mortgage, credit card, and investments, you're a captive revenue stream. Split your financial life. Use Fidelity or Vanguard for investing, a credit union for everyday banking, a high-yield online bank for savings, and big banks only where they actually offer something better, like specific credit card rewards. You regain power the moment you stop being one-stop shop for one institution. A bank isn't a place. It's a machine. And there's another layer most people only notice when it's too late. Fees. Fees look small on paper, but stacked across millions of customers, they're one of the most reliable income streams a bank has. Pure, low-risk cash flow, and they barely do anything to earn it. Count them. Monthly maintenance fee, $10 to $25 just for having the account. Minimum balance fee for dropping below some invisible line. Overdraft fee, around $35 in the US, sometimes multiple times a day. ATM fees, about $3 from your bank plus $3 from the machine. Foreign transaction fees, 3% every time you buy abroad. Wire transfer fees, $25 to $50 domestic, up to $75 international. Paper statement, account closure, early withdrawal, inactivity. There's literally a fee for doing too much and a fee for doing too little. Here's how to kill almost all of them. Switch to a bank with zero monthly fees. Charles Schwab, Ally Discover, SoFi, Capital One 360, Fidelity Cash Management. Schwab reimburses every ATM fee worldwide. I'm talking random ATMs in Thailand refunded by month end. For overdrafts, turn off overdraft protection entirely. Your card gets declined if you overspend, which is annoying once but saves you $35 hits forever. For foreign transactions, get a credit card with zero foreign transaction fees. Chase Sapphire, Capital One Venture, almost any travel card. Never use your debit card abroad. For wires, use Wise or Zelle instead. Wise typically costs a tenth of a bank wire. Zelle is free and instant between most U.S. banks. And never exchange money at the airport, ever. They skim 10 to 15%. Use your no foreign fee card or pull local currency from a fee-free ATM when you land. Americans paid about $8 billion in overdraft fees in a single recent year. That's not a service. That's a penalty dressed up as one. Money creation. What if I told you banks don't just move money, they create it? Out of nothing, just type it into existence. Sounds insane, but it's not a conspiracy. It's how the system is literally designed. You walk in asking for a $100,000 mortgage. The bank approves you. In your head, you picture them pulling cash from a vault. Nope. A keyboard clicks, a number appears in your account, and $100,000 exists now that didn't 5 seconds ago. The bank didn't take that money from another customer. They created it as a bookkeeping entry, backed by your promise to pay it back. Your signature becomes an asset on their books. The $100,000 in your account becomes a liability they owe you. The Bank of England literally published a paper in 2014 titled Money Creation in the Modern Economy. Confirming this, go read it. Over 90% of the money in circulation started life as a commercial bank loan. Here's where this gets genuinely useful. Debt, used wisely, is a tool, not a trap. Banks create money to lend you. If what you buy with that money grows faster than the interest you pay, you come out ahead. That's leverage. The entire game of real estate runs on this. You put down 20% on a house, the bank creates the other 80%, and any appreciation on the full value is yours. A house going up 5% a year means you earn 25% on your down payment, minus interest. That's why real estate has built more everyday wealth than almost any other asset class. The rule is simple. Borrow to buy assets that produce income or appreciate. Don't borrow to buy liabilities that lose value. A mortgage on a reasonable home, a loan to start a profitable business, student debt for a degree with real earning power, these can multiply your net worth. Financing a depreciating car at 9% or putting vacations on a 22% credit card, that's the bank's money machine using you as fuel. Learn that one distinction and your financial life changes. Despite all this creation, somehow your money still seems to shrink. Why? That's the next piece. Inflation loss. Here's a painful math problem. You put $10,000 in savings earning 0.5% a year. A year later, your balance is $10,050. Win, right? Well, no. Because everything you actually buy went up 3, 4, maybe 5%. You didn't make money, you lost money. You just can't see it because the number on your screen went up, not down. This is the inflation tax. You're not robbed dramatically, you're pickpocketed in slow motion. Historically, U.S. inflation averages 2 to 3% a year, with spikes above 9% in 2022. A dollar in 1990 has about 45 cents of purchasing power today. Half your money's power gone just from waiting. Here's how to beat it. Know your real return. Nominal return minus inflation. A savings account at 0.5% during 3% inflation gives you a real return of negative 2.5% every year. The only way to actually grow wealth is to earn more than inflation eats. Historically, the S&P 500 has returned about 10% annually over long periods, roughly 7% after inflation. Real estate around 3 to 4% real, bonds 1 to 2%, savings accounts negative most years. So the move, keep an emergency fund of 3 to 6 months of expenses in a high-yield savings account so it stays liquid and keeps pace roughly with inflation. Everything beyond that belongs in investments, low-cost index funds through Vanguard, Fidelity, or Schwab. VTI, VOO, VTSAX. These cover entire markets at fees of around 0.03%. Not 3, 0.03. Hold them for decades. Let compounding work. Max out tax-advantaged accounts first. 401k at least up to the employer match. That's free money. Then a Roth IRA, which grows tax-free forever. You can contribute up to $7,000 a year to a Roth if you're under 50. That amount invested for 30 years in index funds can easily turn into $500,000 tax-free. Banks benefit from inflation twice. They pay you back in weaker dollars than you deposited, and they charge loan interest that outpaces what they give you. Your purchasing power evaporates while the statement tells you everything's fine. Passive profit. Zoom out. You wake up, go to work, clock in, deal with your boss, commute home, do it again. That's how you make money, hours for dollars. Now compare that to the bank. The bank doesn't build anything, ship anything, grow anything. It's numbers on screens. And yet it pulls in billions every quarter, even during recessions. How? Simple. They built a business where other people's money works for them 24/7. Your deposit earns them interest every second. Your card generates fees every swipe. Your loan pays them back with a premium baked in. You're not a customer, you're a revenue stream. So here's the blueprint to flip it. Automate everything. Set up auto transfer from checking into a high-yield savings account the day after payday. Pay yourself first, even if it's $50. Automate investing. Open a Roth IRA today. Set up monthly auto contributions into a target date fund or broad index fund, and don't touch it. Dollar cost averaging over decades beats almost every attempt to time the market. Kill high-interest debt aggressively. Anything above 7 or 8% is costing you more than the market is likely to pay you, so paying it off is literally investing at that rate, guaranteed. Build an emergency fund of 3 to 6 months of expenses so you never take on debt when life punches you. Broken transmission, medical bill, layoff. These destroy people without reserves. Read the fine print on anything financial. The rich read it. The poor get surprised by it. Use credit cards for rewards, not borrowing. Pay in full every month, or don't use them. And ignore 99% of financial advice on social media. Index funds, low fees, long horizons, spend less than you earn. Boring. Also, what actually works. Everything else is marketing. The system isn't rigged against you like a cartoon villain. It's designed so if you don't understand it, you stay on the supplier side, feeding the machine. The moment you get it, you can flip your position. Use banks the way they use you. If this cracked something open for you, drop a follow. And tell me in the comments, when did you first realize your money was doing more for your bank than it was doing for you?